Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging markets, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, and we have Rafaela Vitoria. She's Chief Economist and Investor Relations Officer of Nasdaq-listed Inter & Co. We're here to discuss potential market and policy trends under a Trump administration. It's great to have everyone with us. Welcome to Trade Talks. Welcome to Market Site. Rafaela, and so we removed that one big piece of uncertainty and got past the U.S. election. So now it's time to think about some of the expectations as it relates to Trump's economic policies. Still very early, but what are you hearing? What are you thinking in terms of promises that were made and what will actually come to fruition?
I think there's still some uncertainty in the air. I know it's not his first term, so we have a little bit of history, what went on the last time. I think that's where expectations are mostly going, particularly in terms of more fiscal stimulus at this point with a reduction in taxes, corporate taxes. But there's also some concern about tariffs and how that can impact inflation and also how that can impact global trade. In general, we are not having a good moment for global trade at this point, so the talks on tariffs are probably what we are most concerned of.
Yeah, so from a global and emerging markets perspective, is that really what you're going to be focusing on, is what trade policy and how that evolves?
Yes, tariffs can impose some negative points for emerging markets. Especially if there are tariffs on commodity where emerging markets are big producers. But there's also some concern how tariffs may impact inflation in the U.S. and that may keep interest rates higher and keep the dollar strong for longer.
Well, let's talk about that, Michael, from the U.S. economist perspective. We understand the rationale behind tariffs, but at the end of the day, these will start to get passed down to the consumer, not really keep inflation in place. Is that what has U.S. economists concerned?
Yeah, but like Rafaela said, there's a lot of uncertainty, and we don't know what the ultimate levels of tariffs will end up being, how broad-based they'll be, and that's really going to decide if it's a relatively minor impact or maybe something that the Fed needs to keep an eye on in terms of keeping track of inflation and making sure that they're staying on that 2% target. So it's still too soon to say in that sense, but it could be more or less something that you can look past, or it could be something that results in maybe Fed rates staying a little bit higher than people could have thought they would have gone at the end of this rate cut cycle that we're in now.
Yeah, and Chris, we saw the immediate market reaction because that uncertainty was removed and there was a concession. Again, this is very early days. I think with the first 100 days of execution while in office, that's another big thing that we'll be focusing on. So we have the election, then we have the transition, then we have the first 100 days. So the market's always going to have a wall to climb. Yeah,
that's what it is. Everyone's positioned one way or other. Look at the VIX coming in from a 25 to a 15, kind of creeping up to an 18 now again. But now the focus has shifted more to the folks that he is headlining for his cabinet appointments and other advisor roles. So that shock to the market has kind of done a whipsaw from, if you look at the major indexes, including the Russell 2000, look at what's happened to the dollar, look what's happened to bond yields. It's whipsawed back and forth, which is good for trading environments, but not necessarily good for investors. So the two big things away from the election, or three big things that have happened away from the election, is that the Fed did cut the 25 basis points, and the problem there was the data that came out. So you're looking at the CPI data, the PPI data, and then retail sales, which is telling you basically that the economy is kind of chugging along here well in the U.S. and the retail and the consumer is spending. Though there are some trade downs. Just look at what happened with Walmart yesterday. Higher income households are now spending a little bit more, which is what they alluded to over the last 2 quarters. And that stock was rewarded with a new 52-week high, all-time high adjusted actually. And then Target followed up, which is one of their closest competitors, and they're trading at a 52-week low now, so there's a have and have not. So the question is, which are have and have nots, and that's what the positioning was coming into the election. Energy is doing well, domestic. Retail, not so much, especially if you're importing from China. To Rafaela's point, the percentage of tariffs coming in is still, you make all sorts of promises on the campaign trail. Right. It's whether or not you follow through, and that's hitting home for a lot of the companies that see their sourcing coming from China, and that's going to be a continued problem if that does come to fruition.
Right, and Rafaela, you make a really good point in your notes here that the focus should be on the continuity of the counter-cyclical American fiscal policy. It is just, it's really been out of whack over the past couple of administrations, and we are at a moment here where we don't have as much flexibility with it.
Yes, and coming from an emerging market, we do have some experience in terms of fiscal expansion. I know that during the pandemic years, there was a need for fiscal spending, for stimulus for the economy to go back. And what is happening now in the US and other countries is that it's very hard to pull back. So once you get that stimulus out, it's very hard for politicians to cut that back. And with an economy going strong, like that was mentioned, it is time to cut some spending. I think it actually helps with inflation. If you think about less fiscal spending, it's actually positive for inflation because you reduce the heat of the economy, you can reduce the consumption by families, and this would add to the Fed's easing cycle now, not to be so concerned about inflation picking up again, because less fiscal stimulus could be actually positive at a time where employment is very healthy and consumption is at a very healthy pace. It is easier to do that in the first year of a new government, so that might be something that might surprise the market, and I don't see the market talking too much about some of the measures of cutting spending. That could be a positive surprise actually going into 2025, less spending and less heat on the inflation side.
Yeah, it's a great point that you make, and Michael, at the end of the day, it's hard to pull back some of these programs that were initiated, but you know what, we stopped with the stimulus checks, we stopped with other programs, consumer spending and the health of the consumers is good as it's ever been.
Yeah, but the change that we've seen over the last couple decades, where we've seen the deficit each year, more or less growing as a percent of GDP, that's also where we've seen longer and longer expansions in the economy. So the trade-off that we've seen with increasing the deficit has been getting these 10-year expansions that we, going from 2001 to end of 2007, 2009 to 2020, and now we're 4 years into this expansion. And the big reason why, at early 2023, everyone thought going into that year we were going to have a recession, but we had a strong consumer spending, but we also had strong government spending, which was a factor there. So there's definitely a trade-off that has to be made because right now our debt isn't unsustainable, but it's on a path where it becomes worrisome. So the benefit is we've had these long stretches without recessions. The risk is that the bond market's going to say this is a problem at some point.
It feels as if it's almost been manufactured, like we won't let it go into recession. And then, another question is it even possible to get the deficit under control? Either tax or you cut, and that's not an easy decision for anybody to make.
Right, and it seems like the plan currently is to keep the deficit on the trajectory that it's been in. So it doesn't seem like there's a near-term willingness from either side of the aisle, really, to get it under control.
We'll just add digital assets to the balance sheet.
Why not, right? But what's interesting about that here, when you look at the consumer names and where the stock markets are done, it's always moved from one headline to the next. AI kind of carried this market forward when really majority of companies were down towards 52-week lows or even trading worse when AI popped. And then with the promise of lowering interest rates a year ago, it was a year ago, right? When they came out, 6 cuts in 2024, and we got 2. 2 cuts, 325 basis points.
Could get a fourth one.
Could get fourth. It's a 50-50 flip right now. Consumers have been the backbone, right? GDP is 2/3 consumer spend. Wages have been keeping pace with inflation. So that's kind of supporting on certain levels here in the U.S. Some companies, like we mentioned a few before, have and have nots, but there are companies that are doing very well here and plenty that are hurting. So the question is, what is going to be the next catalyst that's going to move us? Is it digital assets? It's been on play for a long time. It's not really widely held. Trump has done a 360 from where he was when it was first came out, talking about it in the previous administration to where he is now. The U.S. now holds, $4 billion, $5 billion.
It wasn't even on the national level up until
and even Jamie Dimon's out, promoting it now, where he said that he would never own it. So maybe that's the next currency, along with AI, to continue to move forward. I don't know, but when you look at the market itself, it's still trading very close to 52-week highs, as the major indices do. Even the Russell and the pullback is still doing very, very well. So with that, you have investors putting money to work, And that's because you have lower interest rates rolling off the 2 years, and you're not getting 5.25 anymore. So where are you going to put your money to work? And that's kind of where we're balancing it right now.
Yeah.
I see equities moving higher.
Well, Rafaela, it's interesting. What if that AI story didn't come into the markets in November 2022? Because it didn't just move the tech sector, it moved every other sector that has exposure to this type of technology, which by the way is everything, right? So I just can't even imagine something that will be that big of a catalyst in the near term. Nobody was expecting that on their bingo card in the beginning of 2022.
Exactly. And in the near term, and we've seen that in the past with new technologies, it's very hard to measure how much that kind of new technology can impact the real economy. So I believe there's still a lot of the investments in the investor perspective being more on the headline and the expectations and not really getting the numbers, because those are numbers that are very hard to get. How much productivity can we get from AI in the real economy? I think it's soon to tell, although we see the new technological cycles are faster, they move quicker. It's still very uncertain to measure how much that can really impact the economy and some sectors. I think most of the trades are still based on headlines and expectations. People want to try to get it right. We do see a lot of use for AI to increase productivity in the long term. We do see some short-term uses. They're very special and very interesting, but the real number is hard to get at this point. And I would say there's more speculation on those names than real expectations for improvements in the economy. I would say the growth in the economy we've seen so far is mostly consumption and fiscal spending and very good job market and not really productivity. We might see down the road that productivity is helping the real income for families increase and will relieve some of the pressure in inflation, but for now it's soon to say.
What happens if the dollar remains strong with these tariffs that Trump's administration could potentially implement? What would that provide an incentive for trading partners to devalue their currency? How do you think that would impact the value of the dollar?
Yeah, this has been a very interesting year with a very strong dollar. So not only the international investors are looking in the US and thinking about the opportunities for growth, so probably the change in government has meant more opportunities to invest in the US, and this has attracted more dollars to the US and making the currency even stronger. So it's not only the Fed and interest rates, but I guess investors in general in the world are looking at the US right now as the best place to invest with the best perspective for 2024-5. This means that investors are overlooking perhaps what's going on in emerging markets. China may present some recovery next year. There's been some stimulus in China that we still haven't been able to measure, and we might have some upside for emerging markets next year because investors are not quite looking at that. It's a market that's being overlooked for now. But there's some positive perspective for emerging markets as well.
I mean, we hear about that all the time, how regions in Latin America, how the demographics are strong and they're becoming more of a consumption type of economy. FinTech has certainly made its way through a number of regions there, but it seems as if it would be, it wouldn't behoove anyone to overlook the potential there.
Exactly. Latin American economy is growing faster this year. In Brazil, GDP is going to surpass 3% this year, which is a nice mark. But yes, there's so much concern at this point, and the strong US dollar has put some pressure on the investors.
Yeah. And Michael, a strong US dollar in terms of the US economy, what are some areas that we should be paying attention to?
Well, I think it is really a question that gets back to the reorientation of trade, and you talk about if we get these tariffs, then the idea is potentially getting reshoring and things like that, but maybe it means that I'm just going to move to a different country where there's a tariff differential and maybe even the wage levels are cheaper there anyway, and if you're paying people with a strong dollar, then it works out pretty well from you as an American company or consumer.
Yeah, and Chris, to wrap up here, any thoughts? Have your companies addressed anything in terms of how the dollar's impacted their bottom lines?
Yeah, there was somebody smart yesterday said something on TV and said there's no China like China, especially when it comes to production of manufactured goods. And what the companies that are with the fear of the increase in tariffs are have to reallocate their supply chain to other countries that often make it affordable to ship products in. The question comes down to the quality and the quantity that these new manufacturing sites can produce. Right now, China is one of the only countries that can supply this, so it'll be interesting to see how that impacts bottom lines. I'm not worried so much about Q4 for companies. Let's see what the guidance is for Q1 on the consumer side.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.